Hey everyone. So, ever since I was a kid, I'm still a kid, I was fascinated with David Letterman's stupid pet tricks on his late night television show. And in honor of that, I've been doing stupid indicator tricks with the charts. And in today's episode, we're going to continue with the MACD. So, here we go. So here's a regular old not penny stock, micro cap stock, ATER. Here's a regular stock, IBM. Here's a regular old stock that everybody thinks is going to go up forever, Apple. Now, the goal with trading really is, as far as I'm concerned, to take the minimal amount of risk with a maximal amount of payout. And we don't want to do anything that's so complex that it would require a rocket scientist to do that. Nothing against rocket scientists, by the way. But we want to do something simple. And I want to use an indicator all throughout the series that everybody uses or lots of people have seen, but most people, I think, don't use maybe, to the utmost benefit. Okay, so here's the MACD. 12, 26, and 9 are the regular old MACD settings, and it produces this squirrely lines that go up and down across a histogram. And if I'm looking here at the Apple 15-minute chart, a traditional way of using the MACD might be every time it crosses the zero line, right here when these lines cross above, or it goes from red to green, maybe we go ahead and we buy a little bit of Apple. And, okay, that's fine. I'm down for that. That seems completely somewhat reasonable. Oops, I put it in the wrong spot. The line's crossed over here, and that's okay. It leads to small incremental gains, and that's fine, and I don't have anything against that. I don't want to rag on that, but let's do something crazy. Let's do a stupid indicator trick with the MACD. Let's triple the settings on the MACD. Let's go 36. And then 26 times 3 is 72. Nope, it's not 72. 26 times 3 is 3 times 20 is 60. That would be 78. Okay, there we go. And then let's go to 9 times 3 is 27. So 36, 78, and 27. There we go. So now we're going to get a much different looking MACD. We're going to get one that is way smoother, kind of what we did with the stochastic oscillator, and one that kind of, once it turns positive or negative, has the potential to stay like that for a while. Now, I am, of course, cherry picking here, and not every result is going to look like this, but just give me a chance here, and let's take a look at what happens when we might just take something like Apple. Everybody likes Apple. We'll have a bias for buying it since Apple is a really popular stock. And let's take a look at when the MACD histogram crosses from bearish to bullish and the MACD signal line crosses the MACD line, or whatever those two lines are called at the very bottom. Let's say it happens right around here. And then let's say, to use this as an example, that we put a stop loss underneath the most recent low that was right before the cross. And then let's hold on for dear life. We want to make sure that our profit target is way to the, 20th power larger than our stop loss. So we're going to go ahead and ride this bad boy for as long as possible. And we're going to ride this thing up. And let's just say we'll do a stop and reverse. We'll get out when it turns negative all over again. So that is potentially, getting in at 151 with a stop loss below 149 and a profit target of like 166. That's a pretty great reward to risk ratio. I'm down for that. I hope you are too. Now, that doesn't really optimize the strategy. I don't think that's necessarily the best we can do. I bet we can use a better looking profit target risk to reward type of ratio. Also, just for the record, it's not going to guarantee that you have any kind of, massive success with this system. You're going to have, chances that you get in on a buy trade and then it just immediately drops back lower and you take small losses. But guess what? I would rather lose 9 times out of 10 with the potential for an astoundingly gigantic win than I would, win 9 times out of 10 with really small wins, and then the 10th trade you lose everything. So I would expect that a strategy like this, I would expect that most of the instances are going to be either break-evens or losing trades, and I'm completely comfortable with that. But every once in a while, you're going to get in on a trade, like right here, for example. Stop loss underneath here. You're going to get in on a trade that seems to go for a long way. And the only way to really find optimal profit targets on something like this is to play around with the charts and see what you might think about doing it. But you're going to get a lot of small losses. And I think the goal of a strategy like this would be to take lots and lots and lots of small losses. As I am looking through this, I am wondering why I'm not already doing this, especially when you come across the occasional, looks like, 1 out of 10 seems like a pretty great number here. When you come across the occasional gigantic win here that seems to go for a long time, I can imagine buying, let's say, out of the money option that's $10 away, or let's say 5 to 7% gain. So buy at, if it's trading at 170, buy an out of the money option that expires, and you can do one that expires in the same week. So you're not buying a lot of time, which means it's inexpensive. You could buy one with a, I don't know, like an $8, $9, or $10 profit out of the money. So the 180 call that expires within 7 days. That seems like it would gargantuanly appreciate. And then you would stop out of that options trade if price had crossed down below here. I just like this idea. I like these stupid indicator tricks. The point of this one today is, once again, to try to build something that does a good job of staying in a trade for a really long time, or longer than most people would stay in, with a really tight stop loss. And you would plan on losing, let's say, 80% of the time. But then in the instances where you win big enough to pay off all of those other trades. If you're interested in doing something like this, I don't know if you are, leave a comment below. Today, I'm going to give away a copy of the excellent book, The Tao of Capital, written by Mark Spitznagel, who was Nassim Taleb's partner for a while in Empirica Investments and is the founder of Universa Investments. Nassim Taleb is an advisor to that. I will send one of you that leaves a comment below and says hello. Tell me if you're interested in this strategy, and I will contact you and send you a copy of that book. Thanks for watching. Thanks for being here. I love the ever-loving heck out of you. I'll see you tomorrow, everybody, for stupid indicator tricks. Hey, don't forget, if you like the video, subscribe to the channel, hit the like button, share it with a friend, or, I don't know, become a psychologist and recommend to all of your patients that they subscribe to this channel, and it will improve their mental health. Okay, bye for now.